What is the 90/10 strategy? Legendary investor Warren Buffett invented the 90/10 investing strategy for the investment of retirement savings. The method involves deploying 90% of one's investment capital into stock-based index funds while allocating the remaining 10% of money toward lower-risk investments. This system aims to generate higher yields in the overall portfolio over the long term. Following this method, Buffett professes the potential gains an individual investor could achieve will be superior compared to those investors who employ high-fee investment managers. However, much depends on the quality of the index funds the investor purchases. Key takeaways. The 90/10 investing strategy for retirement savings involves allocating 90% of one's investment capital in low-cost S&P 500 index funds and the remaining 10% in short-term government bonds. The 90/10 investing rule is a suggested benchmark that investors can easily modify to reflect their tolerance to investment risk. How the 90/10 strategy works. A typical application of the 90/10 strategy involves the use of short-term treasury bills for the 10% fixed income component of the portfolio. Investment of the remaining 90% is in higher risk but low-cost index funds. For example, an investor with a $100,000 portfolio electing to employ a 90/10 strategy might invest $90,000 in an S&P 500 index fund. The remaining $10,000 might go toward one-year treasury bills, which in our hypothetical scenario yield 4% per annum. Of course, the 90/10 rule is merely a suggested benchmark, which may be easily modified to reflect a given investor's tolerance to investment risk. Investors with lower risk tolerance levels can adjust lower equity portions to the equation. For instance, an investor who sits at the lower end of the risk spectrum may adopt a 40/60 or even 30/70 split model. The only requirement is that the investor earmarks the more substantial portion of the portfolio funds for safer investments, such as shorter-term bonds that have an A or better rating. Calculating 90/10 strategy annual returns. To calculate the returns on such a portfolio, the investor must multiply the allocation by the return and then add those results. Using the same example, if the S&P 500 returns 10% at the end of 1 year, the calculation is 0.9 multiplied by 10% plus 0.1 multiplied by 4%, resulting in a 9.4% return. However, if the S&P 500 declines by 10%, the overall return on the portfolio after 1 year would be minus 8.6% using the calculation 0.9 multiplied by minus 10% plus 0.1 multiplied by 4%. Real-world example of 90/10 strategy. Buffett not only advocates for the 90/10 plan in theory, but he actively puts this principle into practice as reported in Berkshire Hathaway's 2013 letter to shareholders. Most notably, Buffett uses the principle as a trust and estate planning directive for his wife, as laid out in his will. Special considerations. There are variations of Buffett's 90/10 investing strategy that take into consideration the investor's age and risk tolerance. As an investor nears retirement, it's frequently a good idea to rebalance a portfolio to reflect a more conservative approach toward investing. The investors need to protect their nest egg so they have funds to live on during retirement becomes paramount over the need for continuous growth. For this reason, the percentages in the investment strategy might change considerably. One approach has the investor switching the allocations so that 90% of funds are put in low-risk government bonds and 10% are invested in index funds. Additionally, investors who are bearish may opt for these allocation amounts as part of a crash protection strategy. Other approaches change the percentages for each investment type depending on the investor's risk tolerance combined with other factors, such as their desire to leave an estate to their heirs or the availability of other assets they can draw upon during retirement. That's it for this video. Hope you like the Warren way of investing. If you watched till here, then please consider subscribing our channel. This will motivate us to make more informative videos for you. Cheers.